A warm welcome to my channel. Well friends, in today's video we would not be discussing something about stock market that in general we do. We take different topics from stock market or different topics from financial markets or financial awareness or personal finance topics, stuffs like that. But today's video is something different. This why I am making this video is because a lot of people who follow me and are subscribers to my channel are mostly students, and they find it sometimes easy for them if I share some topics which actually are helpful for them. So in today's video I will be covering a particular function of Excel which probably many of you know, but people who are not aware of it, it's a very handy function that you should be using, in very easy to use, and how to use it, that is what I'm going to explain in this video. So I'll be talking about very simple easy steps and how to calculate using Excel EMI, equal monthly installments. So equal monthly installments, or this EMI term, everyone of us is aware of, because sometime or the other in our life or in our jobs or in our day-to-day expenses, we have actually heard this term EMI, equal monthly installments, or equated monthly installments, whatever you call it. So this is something wherein whenever you buy something from the market and you don't have the full capital to put in and settle the balance, what you do is you actually take a loan from a participating bank, you settle that with the vendor, and then you repay back to the bank with some interest, and that amount cumulative of the interest and the principal is what we call as EMI, equal monthly installments. So that is what we do it. So today we would be showing you a very easy formula to use and to calculate what exactly your EMI should be. So do it yourself. I've mentioned it so that you need not have to rely on anyone, and you can do it very well of your own. So let's take you to the Excel format that you need to use. So friends, the formula that you need to use in Excel is PMT, as you can see on the screen. So for your convenience, I'll just open up one Excel sheet maybe, and we will do it together. So whenever you write any function, obviously the first thing that we do is, say suppose we put in equal to. So equal to, when you put in, it actually sends a message to the system that you are probably putting in some numerical calculation methods. So after equal to, what we are doing, I have given you the function name. The function is PMT, right? So what we will do is we'll just simply write PMT. So as soon as I write PMT, see that PMT function has popped up. So I will double click on that. As soon as I double click, you can see 5 parameters that are popping up, right? Rate, NPER, PV, FB, and type. So friends, I'll just explain you what exactly these parameters are. For your convenience, I've kept it. So first parameter is rate, right? So what is rate? Rate is normal, the interest percentage, or the percentage on which you have actually taken your loan. So whenever you actually take that loan percentage, that percentage is denoted as a percent value, right? 10% or 12% or 14%, something like that. So assuming for our example, we will consider that the loan that you have actually taken, say loan is 14%, right? So for our example, we'll take that loan you have taken as, I'll skip this for now. So loan you have taken as 14%, right? So this is the loan. Now in this particular parameter, that rate that we are going to use, what you have to do is you have to simply divide it by 12 just to come to a rate which is monthly rate, not your annual rate, right? So what we will do is we'll just divide it by 12. So by 12 will actually give you a rate that is applicable for you, correct? So when you divide 14%, which is your rate, by 12, it will actually give you the rate at which you are paying the bank every month. So this formula clearly works on per month basis, right? So what we will do is we will just write it again, PMT, correct? So we have written PMT. Now in PMT, first parameter, as I have said, is your rate, right? So for example, I'll put it right, I6. Now next parameter is NPER. So what is NPER? NPER is number of months, right? Now whenever you take a personal loan or something, or any loan, car loan, home loan, any loan, generally they will say that it's a 10 years loan, it's a 20 years loan, it's a 30 years loan, something like that. So what you have to do is you have to just calculate the number of months. So what you do is number of years into 12 actually gives you number of months. The reason being because the rate you have actually divided by 12 to come to a monthly rate, exactly you have to come down to the number of months as well. Say suppose assuming this is a 10 years loan, right? This is a 10 years say personal loan you have taken. So number of months come down is 10 years into 12, that is 120. So 120 months is your repayment cycle. So your NPER is 120, right? Next value is PV. So PV is your principal amount. Now principal amount is the amount that you have actually taken loan. So there is no calculations needed. You just simply calculate your principal. So suppose the principal amount that you have taken is 1 lakh rupees. Okay. So we'll just put 1 lakh rupees. Done. Now next is FV and type. So these two are basically optional parameters. So what is FV? FV is basically a value which you pass on when you want to calculate what would be the balance amount or the next amount available. So suppose you have paid 5 or 10 EMIs already, you want to calculate the remainder of the balance, then actually that is something that you need to calculate. So you will pass say 1 lakh and then say suppose 20,000 you have already paid, so you will put in 20,000 after that. So it will actually calculate the interest on or EMI amount on 80,000, that is the balance amount. So we are not considering that. So if you are not interested, you just focus on interest, number of months and principal amount. Simple. And we can just keep it as 0 for the time being. We don't want this value. And finally type, this is again a value which we pass to make a calculation. This is a binary value that we pass, either 1 or 0, just to see the next installment. So if you are passing it 0, it will calculate by default at the beginning of the month. If you pass 1, it will calculate by end of the month. So basically in this formula, these two are for high level calculations wherein you want to compare the EMIs with different Excel sheets, spreadsheets. But for us, I think these three are more than enough. So for us, we have done already, we have given this principal amount. Now we'll just pass 0 and 0, and finally see, we are just passing, because it's also mentioning these are optional parameters. So I'm just closing the brackets. I'm passing a tab. So this amount, so it's by default it's showing in dollars. That's fine. We are not bothered about that. So the amount that comes down is 1552.66. So this is your EMI that you are supposed to pay for the next 10 years and to repay 1 lakh rupees. Now if you want to calculate how much this amount is, so what we can do is we will just do it 120. So friends, this is the amount that is what you are going to repay to the bank. And obviously your principal, right? Your principal amount was 1 lakh. So extra what you have paid, that is this one minus this one. So this is what you have actually paid in extra. I think it has actually calculated in a negative way. Anyways, so 1,86,000 if you consider is what you have actually paid back to the bank in the over the period of 10 years, and your principal was 1 lakh rupees. So 86,000 rupees you have actually paid extra. So obviously I'm not giving you any moral gyan or something like that, because it's not always possible that you buy everything with cash. It's not possible. If say suppose someone want to buy a house for like 50 lakh rupees, it's not possible for you to save 50 lakh and then buy a house, right? Obviously you have to go for EMIs, because at the end of the day money doesn't have a value. If you want to put 50 lakh rupees and buy a unit with all the cash that you have, it's not a very logical thing to do, because that valuation you will not be getting. Instead you pay EMIs and you invest that 50,000. That is altogether a different topic that we can discuss later on, and we can see some differences. If you buy something in cash and if you buy something in mortgage or EMI, then what is the difference and what's the plus and minus. So that is a topic that we will be taking in a personal finance session. That is an altogether separate topic. But for this one, I hope this concept is pretty much clear. I wanted to give you an idea how to use this pretty easy function, that is PMT in Excel sheets. I hope this concept is clear. If you like this content, do not forget to subscribe, and do let me know if there are any other topics that you are interested in. I'll try to work on that. I'll make a video. And also, if you want, you're interested more on share markets, you want to invest on quality stocks and stuffs like that, then I've given my social media, Twitter and Telegram links in description, and also I've given my personal mobile number. You can WhatsApp me on that number, and you can be part of my private group as well. Thank you so much, and I will be back with something informational as soon as possible.